On May 29, 2026, the CFTC did something it had spent the better part of a decade refusing to do. It approved a Bitcoin perpetual futures contract on US soil for the very first time in history. Kalshi got the green light, launched within days, and crossed $1 billion in trading volume in its first week. And just to put that into context, perpetual futures are the single biggest trading product in all of crypto. In recent quarters, derivatives volume has dwarfed the spot market, by some estimates running more than 5 to 10 times larger, depending on methodology and which exchanges you count. Let the scale of that sink in for a second. 5 to 10 times the entire spot market. The truly extraordinary part is who the regulators choose to bless and who they are very deliberately left standing outside. So today, I'm going to break down exactly what the CFTC approved, walk through why this is genuinely bullish for crypto and for hype in the short term, and lay out why this same decision is actually a warning shot aimed straight at Hyperliquid. My name is Lewis, and you're watching the Coin Bureau. Now, before we get into the warning shot, you need to understand the precise mechanics of what happened, because the headlines are blurring two completely different events into one. There were actually two separate CFTC actions on the same day, and they are not equal. The first is Kalshi. Kalshi received a full commission order under Regulation 40.3, which is the highest weight regulatory stamp the CFTC can issue for a new contract. The full commission signed off on this directly, rather than just issuing a staff memo. Their product, BTC Perp, is a cash-settled Bitcoin perpetual, listed on a designated contract market, cleared through Kalshi's own clearinghouse, with full KYC, surveillance, and position limits. In plain English, this is the gold standard onshore license, and it's the first true perp ever approved in the United States. The second action is Coinbase, and this is where the nuance matters. Coinbase, however, only received a no-action letter from the CFTC's Market Participants Division, which functions as staff-level relief. What that letter does is allow Coinbase, acting as a registered broker, to route U.S. clients to perpetuals listed on Deribit, its offshore affiliate, treating those trades as foreign futures. So Kalshi is a domestic product. Coinbase got a compliant bridge to offshore liquidity, which brings us directly to the question of why any of this matters in the first place. Firstly, we need to know what actually is a perpetual future. Put simply, a perpetual or perp is a derivative that lets you bet long or short on an asset's price, with leverage, without ever owning it, and with no expiry date. A traditional future forces you to roll your position into the next contract month and pay spreads every single cycle. A perp never expires, so you hold one position indefinitely. The clever part is something called the funding rate. Because there's no expiry to force the price back to spot, the contract uses periodic payments between longs and shorts, typically every 8 hours, to anchor the perp price to the underlying. If the perp trades above spot, longs pay shorts, which cools the price down. If it trades below, then shorts pay longs. It's a continuous market-driven gravity that keeps everything tethered, and this product is enormous. Global perp volume in 2025 came in somewhere between $61.7 trillion and $92.9 trillion, depending on whose data you trust. For context, that's up from roughly $28 trillion in 2023. Perps now account for over 70% of all volume on centralized crypto exchanges. And here's the part that should make every US trader sit up. Before this approval, the vast majority of crypto derivatives volume, by virtually every estimate well over 90%, ran through offshore or unregulated venues. US traders were using VPNs to access Binance and Bybit because there simply was no domestic option. The honest framing is that America had locked itself out of the single largest product in its own emerging asset class. Now, you might assume the US sat on the sidelines out of pure caution. However, that assumption ignores the turf war underneath of it. The core problem was definitional. Is crypto a commodity governed by the CFTC or a security governed by the SEC? That ambiguity created a regulatory no man's land where no exchange wanted to launch a product that could trigger an instant enforcement action. Under the previous regime, this was regulation by enforcement, and it froze the entire onshore market solid. The new CFTC chairman, Michael Selig, has explicitly framed this approval as moving the agency towards what he calls responsible innovation, with the stated goal of making the US the crypto capital of the world. Which brings us to why this is so structurally bullish for the broader market. The single biggest unlock here is institutional capital. US pension funds, hedge funds, and asset managers operate under compliance mandates that flatly prohibit trading on offshore, unregulated exchanges. They literally cannot touch Binance without violating their own fiduciary duties. That meant they were locked out of the deepest hedging instruments in crypto. They couldn't run delta-neutral strategies collecting funding rates. They couldn't hedge spot Bitcoin treasuries with perpetual shorts onshore. With a regulated venue, all of that becomes accessible for the first time. And the demand was clearly pent up. Kalshi clearing $1 billion in volume in 1 week, with the open interest hitting a record $810 million, up 28% in a single week, tells you that this capital was waiting at the door. This is the same dynamic we saw when the spot Bitcoin ETFs opened a compliant front door for an entirely new tier of investor. The Perps approval is potentially doing exactly that for the derivatives market. Now, look, I want to be fair and give the skeptics their voice, because this isn't a one-sided story. CME Group's CEO, Terry Duffy, has publicly warned that the approval of crypto perps poses systemic risks, comparing the environment to the lead-up to the 2007 financial crisis. He points to the October 10, 2025 event, where $19 billion in leveraged positions were liquidated in a single day. And of course, we should absolutely trust that retail traders handed 250x leverage on offshore venues will manage their risk responsibly, right? That's precisely why the CFTC is signaling a far more conservative onshore framework, with leverage capped somewhere between 5 and 10x, versus the 50x to 250x available offshore. And that brings us directly to the player everyone holding hype actually cares about: Hyperliquid. Because if regulators have just legitimized perps as a product category, then the dominant perps venue should, in theory, get a serious valuation tailwind. And Hyperliquid is dominant. This is the leading perps DEX on Earth, commanding over 50% of all on-chain perpetual volume and more than 70% of decentralized open interest. It processed over $190 billion in volume in April 2026 alone, which illustrates the sheer scale of this platform. And that figure reflects just a single month of activity. And here's the genuinely clever part of the model. Hyperliquid runs an assistance fund that recycles around 97% of all protocol trading fees directly into daily open market buybacks of HYPE. More volume means more fees, which means more buybacks, which means upward pressure on the token. To date, that mechanism has deployed over $2 billion into HYPE purchases. So, when the CFTC blesses the entire product category, the logic is simple. The category leader deserves a premium. And the market agreed, at least at first. HYPE hit an all-time high above $73.50 in the week of the news, and HYPE spot ETFs from Bitwise, 21 shares, and Grayscale collectively pulled in over $150 million in cumulative net inflows following their launch, with notable momentum coinciding with the CFTC announcement. Kalshi has even filed for a HYPE perpetual of its own, which is a direct institutional stamp of legitimacy on the asset. So, in the near term, the bullish case writes itself. But here's the part nobody cheering this approval wants to look at too closely, and it is the entire reason this video has the word warning in the title. The CFTC specifically blessed fully KYC'd, registered, federally supervised venues, leaving permissionless DEXs out in the cold. Kalshi and Coinbase require identity verification, position limits, and central clearing. Hyperliquid is none of those things. It's permissionless, self-custody, with no KYC, leverage far beyond the onshore cap, and the ability to list literally anything through its HIP-3 framework, from oil to SpaceX synthetic shares. So we have a fundamental tension. The legitimization of perps as a product is bullish for Hyperliquid broadly, but the legitimization of a specific venue type, the regulated KYC'd kind, is potentially hostile to everything Hyperliquid actually is. And the market is pricing both of these at once. All you need to do is just look at the price action. Hype is up over 37% over the last 30 days, which reflects the product's legitimization tailwind. But it's down nearly 15% on the week. That gap is the double-edged sword playing out in real time, right there on the chart. The monthly rally is the legitimacy story. The weekly downtrend is a regulatory risk discount, plus a $684 million token unlock on June 6th, plus Arthur Hayes dumping his entire roughly $18 million position on June 4th. And the regulatory pressure is not theoretical. The UK's FCA added Hyperliquid to its unauthorized firms list. CME and ICE, the traditional incumbents, are actively lobbying the CFTC to force Hyperliquid to register, citing market manipulation and sanctions concerns. There's even some historical precedent here. Back in 2022, the CFTC sued a decentralized token-governed protocol called UKI-DAO and won, establishing that decentralized governance does not shield you from CFTC jurisdiction. Now, look, that ruling is several years old now, and the current CFTC is far more innovation-friendly than the agency that brought that case. But the principle remains the foundational precedent every analyst points to. And this is the part that most coverage is too surface level to reach. The honest truth is that the most dangerous risk to Hyperliquid is a structural choke point. Hyperliquid's entire liquidity engine runs on USDC, which is issued by Circle, a US regulated company. Which means that regulators don't need to shut Hyperliquid down directly. They just need to pressure Circle to restrict flows to non-compliant platforms. Pull that lever and the liquidity drains without a single enforcement action ever being filed against the protocol itself. That is the asymmetry nobody is talking about, and it's the genuinely structural fragility underneath the buyback flywheel. Because remember how that flywheel works. Volume drives fees. Fees drive buybacks. If a chunk of US-bound volume gets diverted to compliant revenues, or if the USDC tap gets squeezed, the fee stream compresses, and the entire token thesis weakens at exactly its strongest point. But, and this genuinely matters, the story is not one-directional doom. Because regulated venues are boxed in by the very rules that legitimize them. The CFTC will never let Kalshi list a SpaceX synthetic perp, or a long-tail altcoin, or offer 50x leverage, or run derivatives on a weekend when CME is closed. Hyperliquid does all of that today. When crude oil has a crisis on a Saturday and CME is dark, where does the world actually trade? On Hyperliquid. That is the structural moat regulated venues simply cannot replicate. So, which side of the regulatory tide is Hyperliquid really on? The honest read is that it depends entirely on which trader you're talking about. Institutional US flow will migrate to Kalshi and Coinbase because it legally has to. But the global, crypto-native trader who wants higher leverage, self-custody, and access to assets no regulator would ever approve is not abandoning Hyperliquid. And there's a genuine argument that regulated venues grow the entire pie rather than cannibalizing it. If Kalshi brings in institutions who previously avoided perps entirely, total market volume expands, and Hyperliquid can hold its absolute volume even as its percentage share compresses. For context, Kalshi's $1 billion first week is still a fraction of Hyperliquid's monthly volume. The threat is real, but its pace is genuinely uncertain. So, the strategic fork for Hyperliquid is brutal. Path 1 is lean into the permissionless ethos. Bet that regulated venues can never replicate the long-tail assets and leverage, and accept being legally barred from US institutional capital. The risk there is fragility, And we already saw 2 major market makers reportedly withdraw in May under regulatory scrutiny. Path 2 is build compliant on-ramps, which immediately raises the question, if Hyperliquid bolts on KYC, why not just use Coinbase? What Hyperliquid is actually attempting is a clever third path. It launched a policy center led by a prominent crypto attorney, arguing that on-chain transparency is genuinely superior surveillance for regulators than legacy opaque systems. It's pushing for a tailored framework under the Clarity Act. And critically, it's building institutional access around the protocol without putting KYC inside of it, through Grayscale and Bitwise ETFs, Kraken staking, and a Coinbase USDC Treasury partnership announced June 8th that could add up to $200 million in annual revenue. There's even a HIP-4 collaboration that puts Kalshi's regulated markets onto Hyperliquid's execution layer, a regulated front end running on a decentralized back end. Which means the most threatening competitor might also be a technical partner. So for you, the practical implications are specific, and here's exactly what to watch. First, watch the CFTC's altcoin perp expansion. Kalshi has filed for a further 12 altcoin perps, including Hype itself. If a Hype perp gets approved on a regulated venue, it's simultaneously a validation and a shot across the bow. Second, watch the volume migration month by month. Compare Hyperliquid's monthly volume against Kalshi's. Is the regulated venue eating DEX share, or is it expanding the whole market? Third, watch the Clarity Act. It's either the tailored protection Hyperliquid needs, or a set of obligations that it cannot meet. Fourth, watch Circle and USDC. Any move by regulators to pressure stablecoin flows to non-compliant platforms is a choke point risk going live. And fifth, watch the November 2026 token unlock. That is the real stress test for whether the buyback engine can actually absorb the supply pressure that Arthur Hayes specifically flagged on his way out the door. So here's the question I want you to genuinely comment about down below. Is the CFTC's approval a rising tide that lifts Hyperliquid as the dominant player in a now legitimized category, making this structurally bullish? Or is it the opening move in a slow regulatory squeeze that channels all the institutional volume into KYC venues and leaves permissionless DEXs boxed out, making it a structurally bearish warning shot? Because the product is clearly winning. The only real question is which venue type captures the volume. So get genuinely opinionated down below in the comments, because I want to hear where you land on this. And also if you own Hype, if you're bullish on Hype, or if you're bearish. And if you want our research team's read on every regulated move as it lands, plus a slice of weekly forward guidance, then sign up for the free Coin Bureau newsletter using the link down in the description. It's genuinely worth it. And if you want to understand exactly how Hyperliquid built the dominance that's now in the regulatory crosshairs, then check out our deep dive right over here. Thank you all so much for watching, and I'll see you again very soon. It's Lewis, signing off.